Okay. This recording has started. Okay, first practice regarding receivable. So, as we discussed it on Monday, so company have to assess the risk of non-collectability of their receivable and make an adjustment entry to account for that risk. And the way they do it is to prepare an aged balance of the receivable. This is an example where we have the list of our receivable. This is the customer name, the total amount due from every customer, and the age of every receivable. Some of them are less than 30 days, 31 to 60 days, 61 to 90, over 90 days. And of course, the more the age is, the more the receivable is old, the more the risk is, right? Then they give us the percentage for every category. So receivable that are due, not yet due, have a 3% risk of non-collectability. Receivable that are due 1 to 30 days, 6% risk. 31 to 60 days, 10%. 61 to 90, 25%. Over 90, 50% risk. There is a 50% risk that we will never collect this amount. 50% risk because it is overdue, 90 days overdue. So we first calculate the dollar amount of the risk based on those percentage and the total amount of the receivable. Simply multiply the total for every age, every category by the risk percentage. Okay, and then we get the total, the dollar amount for every category. So there is a risk that we lose $4,200 among the $140,000. There is a risk that we lose this among this, and so on, until we get the total risk among the total $261,000 of receivable. There is a total risk of $34,000. This is just a risk. This is not a reality yet, okay? We just based on our statistics, there is a risk that this amount is not going to be collected. In accounting, we don't wait for risk until it becomes a reality to account for it. Whenever there is a risk of loss, we have to account for loss in advance. So as soon as we get this number, then we have to make the journal entry, adjustment entry to recognize the bad debt expense and the allowance for doubtful account. So after you make this aged balance of the receivable, what you have to keep in mind, the total, this number is the number that should be in your balance sheet as allowance for doubtful account. This should be in your balance sheet as allowance for doubtful account. So the question here, journalize adjustment entry to record the expected credit loss. And they say on December 31st, the unadjusted balance of the allowance for expected credit or allowance for doubtful account prior to agent analysis was $9,000. Let me change the name here so that we be consistent with the textbook allowance for doubtful accounts. And prior to the agent balance, which it was $9,000. So the allowance before this adjustment, it was $9,000, right? Credit balance $9,000. In order to be able to make the journal entry, this is where you have to really pay careful attention, because many students will do we'll take this amount and put it in the journal entry. There is a journal entry. The journal entry is debit, bad debt expense. And credit allowance for doubtful accounts. Debit, credit, recognized expense, and account for the allowance. The very common mistake I really ask you not to do is to put that number, the result of the calculation. No, the $34,000 is not what should be in your journal entry. The $34,000 is the ending balance after the adjustment is done. After this journal entry is done, after the adjustment is done, you have to end with $34,840. Which means, considering that they say the existing balance before the adjustment entry what was $9,000, the $34,000 you have to put it here as an ending balance. After the adjustment is done, you have to end with this 34,800. Now, before adjustment, the balance is 9,000. After the adjustment, I have to end with this. So the question is, what is the X amount that will bring the balance from 9,000 to $34,000? And that X amount is what you put in your journal entry. Okay? Because the agent balance doesn't give you the adjustment, the number for the adjustment. It gives you the ending balance. Subsequent to your adjustment entries, you have to come to this number, which simply means I only have to calculate an X amount. What should be X so that the allowance for the credit balance will go through from $9,000 as an unadjusted balance to $34,000. How do I get that X? Simply the difference, 34,000 minus 9,000. And that's what should be in your journal entry. So to account for the credit risk for 2023, debit, bad debt, expense, and credit allowance for doubtful accounts for that amount. We have just the X amount. Does this make sense? So the step, I first prepare my agent balance, convert the percentage of risk into dollar amount of risk, calculate the total amount of the risk, and that total amount should be the ending balance of my T account for the allowance for doubtful account. After the adjustment is done, I have to get to that amount, which is calculated mathematically through the agent balance of the receivable. And then after that, they say, journalize the following selected transaction. On March 1st next year, so what we have done is for December 31st, 23. And then the next year, this happens on March 1st, an $800 customer account that originated 2024 is judged uncollectible. Suddenly, one of our clients went bankruptcy, and then the amount is uncollectible. What journal entry should we do in this case? To account for non-recoverable amount. Yeah. What journal entry should we do to account for non-recoverable amount, which is the write-off? Account for write-off. So usually the first thing that might come to mind is, okay, I just lost $800. We may expect to account for a loss, but we should not account for a loss because the loss has already been done. This is the accounting for a loss. You account for the loss as soon as it becomes probable, not when it becomes a reality. We are not talking about a likely loss. This is a real loss. The $800 is really lost. Okay? It is not just a matter of estimate or doubtful. What happens is that loss has already been provisioned in advance when we made the journal entry. When we made the journal entry, this bad debt expense, it covers all the losses in advance. You remember, how did we get the $25,000? Based on percentage of losses, right? So the loss was already being accounted for. We don't recognize another loss when it becomes a reality. When it becomes a reality, we just take from the provision, because this is a provision to cover any future loss. So just take from the provision, debit, allowance, and cancel the receivable. That is how we count for write-off. We cancel the receivable. No, there's no hope to collect anything now from this client. So credit account, so credit the account receivable. And debit allowance for doubtful account. The same account. This is how you do to account for write-off. When we do this, we are making a write-off. So this receivable is removed, but it is removed and we debit, we reduce the allowance. That is the provision. And then the other event that happens on September 1st, so they say on September 1st, another $800 check is received from the customer whose account was written off as an uncollectible in March 1st. This may happen in real life. March 1st, we got the information the client was bankruptcy, no hope, no way to expect any payment. Good news, many months later, there was a judgment and maybe the client received maybe a donation from the government or something happens so that now they are able to pay that amount. But that amount was written off. The amount which we just collected, it was written off. So how are we going to account for this recovery? Two steps. First step, reverse the write-off. The write-off we did on March 1st, the first step is we reverse it. When we reverse it, we recreate again the receivable that was deleted, and then we recreate the allowance. We simply reverse the entry, so debit account receivable and credit the allowance without account, so that we reverse the entry of write-off. And then after that, we account for the collection, which means cash, debit, and credit account receivable. $800. Okay, this is all you have to do when it comes to receivable. We have a full story with all the steps: recognizing the bad debt expense, updating the allowance, accounted for write-off, and accounted for recovery. Any question about this? Okay. Now, bank reconciliation, an illustration of bank reconciliation. So this is from your textbook, 512. It should be 512, not 612. 512. So the data is, this is the bank statement we received on April 30. Open and balance. This comes from the bank, okay? Open and balance and notes collected, and this is all the information. And in our books, this is the cash in bank account. Opening balance 23,000 on April 1st, and then there will be the checks issued, total of 41,000, and deposit. And other information, outstanding checks at April 30, $4,100. What is this? What is the $4,100? What does it mean, outstanding checks? Outstanding checks. Those are the checks that the company has issued, but not yet used by the beneficiary, not yet deposited by the beneficiaries. As you can see here, the company has issued a total of 41,100 during the month of April. During the 30 days of April, they have signed and issued checks to the suppliers for a total of 41,100. Among that amount, a portion is still outstanding at the end of the month, $4,100. There's no deposit in transit from March, and deposit in transit at April 30 is $5,400. What does it mean, deposit in transit? Deposit in transit. So
it's a check that we haven't received money.
The checks come from our customers, from our clients, and we deposit the checks to our bank, but the bank did not yet record those checks. So the amount is not yet added to our balance of the bank, because the deposit happens maybe the last day of the month. Okay, so this is the information we need to make the bank reconciliation. The next sheet is to make the bank reconciliation. Go ahead. What should we do? This is the structure of the bank reconciliation. Unadjusted or the balance before reconciliation, and then cash balance as per the books, my accounting, and as per the bank statement, and then a list of addition and list of deduction on every side. So the challenge is to identify the reason of the discrepancy between the two accounts, and identify which party should add or should consider that, and then whether it is in the addition, on the add side, or the less side. Considering this information, what is the balance, the ending cash balance as per books? As per books, in my accounting, we are making the bank reconciliation as on April 30. So this is the balance on April 30. From the bank side, it is 23,550. I can put it here. And then balance as per the bank statement equal that amount. This comes from the bank statement. How about our books, our own books, our accounting? How much is the balance of the bank account as on April 30? I have the balance on April 1st. I don't have it directly on April 30, but I can calculate it. How to get the balance of the cash in bank on April 30? Yeah. Opening balance plus deposit minus check rate. That's it, simply. So we can calculate it here, below. The balance on April 1st, 23,500. Add the deposit per books, less the check written, so we have the balance 23,000. Okay, equal. Now the goal of the bank reconciliation, these two balances are about the same account. Theoretically, they should not be different, but they are different. According to our books, on April 30, this is what we have. We have 23,900. But according to the bank, we have 23,550. The bank reconciliation is going to justify that difference, and when we finish the bank reconciliation, we should end with the correct balances that are similar. And why? What is the reason of this discrepancy? Each of the two parties is missing some information. From our side, there are information that are here that we don't know. And from the bank side also, there are information that are counted here, but the bank doesn't know. So the challenge is to identify the source of discrepancy and then put it on the good side, on the right side. So they say outstanding checks as at April 30, $4,100. Is this a reconciliation item? Which means, is this an item that created that discrepancy? Is this the $41,000? Is it an amount which is known by one party, ignored by the other? $41,000 is the amount of checks that the company issued. The company issued these checks to their suppliers, but the beneficiary did not yet submit the checks to the bank, which simply means the bank is not aware of it. They don't know. They are not aware that you have issued these checks. So, yeah, this is a reconciliation item. Someone doesn't know this information. It has to show up in your bank reconciliation statement. Which side? Which one? Which of the two parties? This is us, and this is our bank. Which of the two parties ignored the $4,200, the $41,000 of outstanding checks? The bank. So it should be here. The goal of this reconciliation is to complete the missing information. The bank does not know that we have issued $4,100 of checks. So it has to be added on this side. Now the question is now, is it going to be on the addition list or the deduction list? Is the $4,100 go to increase or decrease our balance in the account? These are checks that we have issued to our suppliers. So it should be on the add list or the less list. So according to the bank, what we have as a cash account is $23,000. The bank believes that we have $23,550. But they didn't know that we have issued $4,100 of checks to our suppliers. Now that they know it, because we are going to add the information, should we put that number on the add list or minus list? Minus. It will decrease our balance in the account. The $4,100, once they would be deposited by the supplier, it will decrease. They will take from our cash. So in the deduction list, we add the outstanding checks minus $4,100. Okay, good. So now with this correction, now the formula, I had to put it with a plus because the formula is already added the minus. Okay, so according to the bank, we have $23,000. Now that we know that there are also $4,100 of checks outstanding, then the corrected balance is $19,000. Okay, we are close to the corrected balance. Now the other source of the discrepancy is they say deposit in transit at April 30, $4,500. This amount, who ignores this amount and who knows it? we as a company, do we know that we have this deposit? Deposit means checks received from our client that were deposited into the bank, but the bank did not yet record them because they will deposit April 30. We have added this number to our balance, but the bank doesn't. It is not added to the means from the on the bank statement, right? So, in which side of the bank reconciliation this amount should appear? On the? Yeah, before additional deduction. In which side? On the side of the bank as an addition, because now, this will increase the balance as per the bank statement. So in the addition list, we have to add deposits in transit, and the amount is okay. So if we look at the data we have, so there is nothing else. There's no additional information that the company knows and the bank doesn't know. The only two information is this. They are done. Okay. Do we have reconciled balance? Not yet. When we add all of this, we end with 23,550. Did I take the right number? The deposit is not the right number, right? Deposit 5,400. Yeah. You see? No. And then correct and then balance 24,000, but here 23,000. So still have discrepancy. So what does it mean? We have to look for information that the bank knows and that I ignore as an account, as a company. So if we go back to the statement, okay, the bank statement, this comes from our bank. Deposit during April, already counted. Notes collected for the company, including $70 of interest. 1,180. The bank has collected in our favor for us or our benefit 1,180. And that note it is not counted in our books. So this is a reconciliation item, an item that has created the discrepancy because we don't know that we have collected this amount until we receive the bank statement. So the question is, since we are the party that does not know this information, clearly it has to be added here on this side. It has to correct the book side. Now the question is, should we add it or subtract it? Is it on the add list or on the deduct list? Is it something that will increase our balance or decrease our balance? Increase. So this is collection from client. So in the add list, and we're going to add here notes collected, and we also have to add the interest because it includes $70 of interest. So interest revenue. So the interest revenue is $70 and the note is 1,180 minus the $70, right? So there is 1,110 of note collected plus an interest revenue of $70. And the other information here, they say an NSF check for this client, right? AB right. Non-sufficient fund, $160. How is this going to be included in the reconciliation? So what is the story here? What is it about? What does it mean? NSF check for AB Wright. AB Wright is our client, one of our clients. We have a check, we have deposited to the bank, and we thought we have collected the money, and suddenly the bank returned check, NSF, non-sufficient fund. The client doesn't have the money. So this is a reconciliation item, and it has to be corrected. So we were not aware. Now that we know, we have to adjust our balance. Now, on the add list or on the deduction list? On the deduction list, NSF $160. Okay, and what else? Bank service charges, $70. Do we have it here? We don't have any bank service charge. All we have in our accounting is the deposit and the checks. We don't have any bank service charges. So we did not know, we were not aware of this. And now with the bank statement, now we realize that we have a $70 of bank service charge. That's one of the reasons the balance was not identical. So now this $70 has to be added to the bank reconciliation. Which side? The bank already knows this, so we can't add it here on this side. It has to be added on this side, the company's side. As a add or less? Less. So on the deduction list, so bank charges, $70. And that's it. As you can see now, we end with a corrected balance of $24,850 in our books after correction, and ending correcting balance for $24,850. Now we can say that the reconciliation has been made, and we managed to justify the difference. So next step is to do what? I can check for control purpose that the difference is 0. This minus this. Next step. This statement, the bank reconciliation, is not an and. It is not a goal in itself. It's just a tool to correct our books. We now have to make the journal entries to account for this. We now have to make the journal entries in our books to account for the missing information. We did not know there was a note collected. Now that we know, we have to account for it. We didn't know that we collected an interest revenue. Now that we know, now I have to account for it. NSF, now that we know that one of our clients did not pay it, we have to account for it, and the bank charge. So we have to make journal entries for this. The question is, should I do the same on this side? Why or why not? This is the bank. This is the books of the bank. Do I have access to the books of the bank? To the accountant of the bank? I have no access. I cannot make journal entries on the books of my bank. All I can do is just to take note, to notice what was missing, keep track of it for next time. That's it. But there is no journal entry to do with regard to this. So all journal entries should be done here. So now next sheet, make the journal entries. So let's start with what journal entry should I do to recognize the note collected and the interest revenue? Debit what? Credit what? Note collected from our customer. So this is a note receivable, okay? And it was paid. Now we have the money, we have cash. So debit cash and credit note receivable. And the $70 of interest, that is an interest revenue. So debit cash, credit note receivable, $110. Credit interest revenue, $70. And debit cash for the total. This plus this. Okay? Now I need the journal entry to account for the NSF. What do you suggest? The non-sufficient fund. How will you account for this? Okay. Can we rebuild the story of this check? This check that was we received from our client subsequent to what? At some point there was a sale to this client. On that day we credited sale revenue and we debited account receivable, right? And then after that, when we deposit the check, we debited cash and credited account receivable. Because we were under the belief that we have collected the money, so we debit cash, credit account receivable. Now that it ends up to be, no, that was false. There's no funds, so we have to correct this. We have to recreate the receivable and credit the cash. There's no cash in reality, so credit cash and debit account receivable. Account receivable on the debit side, $160, and cash, $160. That way, we recreate again the receivable. Now we still need this client to pay us the amount, and we credit cash because it was a false debit that was done before. And then the last item that requires journal entry is bank fees. So this is an expense. So like any expense, debit, bank fees, expense, and credit cash. Bank charge expense, $70, and credit cash, $70. Okay. So this is the bank reconciliation. So now, can you please summarize the process for bank reconciliation? If you have to do this on your exam, what will be the next step? What will be the steps? First of all, what do we expect on a problem about bank reconciliation? The background data and the problem should be what? We need what? 3 documents. Bank statement on one side, on the other side, what is in our books, and a narrative, a list of additional information. Bank statement, our books, the account, and the list of additional information where they are going to tell us stories about NSF, about collection, about error, right? Then, with that information, what should we do? The first step is to prepare the bank reconciliation. What is the structure of that bank reconciliation? Whether it is done on Excel or on paper, exactly same thing, right? Absolutely no difference, no matter where you write the information. So I simply prepare the structure of my bank reconciliation, and even I really have to prepare the structure, the full structure, which means I might not have enough time to finish it, okay? But the structure, there are marks for the structure, just for the titles. So let us get at least marks for the titles, even if it is not balanced, if it is not finished. So I prepared something which is called bank reconciliation. With two sides, two blocks, our books, and on the books of the banks of the bank. Banks, books. Starting point is what? The first line. So the balance before reconciliation. Okay? Balance before reconciliation. Same thing here. Balance before reconciliation. And then next, on every side there will be an add and minus. Addition as a title, and I will have a list of addition and deduction. Less the minus. And less something. Same thing on the other side, addition. Deduction. Once it is done, I should add with what? Reconciled balance. That should be similar. Reconciled balance. Reconciled balance. I need you to know that if it was an exam, there are marks for all of this. Before doing anything, before putting any number, any dollar amount, marks for the titles. So let us start with gathering those easy marks first, right? So even if I don't put any number for this, at least maybe 5 or 6 marks I can gather just by doing the structure. That's it. And then after that, depending on the time and the information I have, I start to fill this form. It becomes like a form to fill. Just like fill the form, simply. And then I might miss some items, so I might get some correct items, additional marks, but I really have to prepare this structure, and then after that, where do I have this information? The balance before reconciliation in our books, from the T account, our T account, our books. The ending balance, I don't not take the opening balance, the ending balance for the period. The balance on, for example, April 30, not April 1st. And this number, where does it come from? From the bank statement, again, ending balance. What kind of information will be here in the addition side of my our books? Yeah.
Be the documents, the supporting documents.
Yeah. Give me an example of what we can find here.
Say.
So this is our books. It should be an information that we don't know, and we just discovered when we received the bank statement.
Like interest checks or.
Very good. Interest collected or notes collected. So this is something that will increase our balance. Okay. What could be in the deduction side? Example of what could be in the deduction side.
Like a bank service.
A bank fees, bank interest, could be an error, mistake. Okay, good. What could be in the addition side of the bank statement? Something that the bank doesn't know, I know, but the bank doesn't know, and it increases my balance. Yeah.
Deposits.
Deposits in transit, the very common item I can have here, and deduction usually are sentence checks. And also we can always have errors on all 4 parts of the of the map. We can have error affecting this side or affecting this side with an addition or reduction. Okay, so it doesn't make any sense whether it is done on Excel or on paper or same thing. If it has to make a journal entry, you are going to do it this way: debit with this position and credit this position. So same thing. Okay, let's take a break, 10-minute break, and come back for the rest.
Yeah, you scared. Because there's no way you and also it's very impractical. This is like a kind of application.
The DSM pull up to and meanwhile, I was also
Oh yeah, I saw that shit. It's Holland's roommate. I like fat.
Let's go.
That should be your next one. Sorry.
Actually, you have a stand up. Bro, you're way bigger than us. Now you're taller.
I wanted to get pink. I'm being saying
That is what that sounds like dope, bro. It's don't even stress, bro. You don't even stress about that. Look at the stats, bro. Look at the stats. The only reason why he's having a shit season is because our OC, bro. Our OC is ass.
It's like everything's black, right?
no, 9,500. Oh yeah, let's go.
How is your group project progressing? Any difficulties, any problems? Are you doing? Are you progressing with your
Just like for
analysis? If you have any issues, then you know. But don't leave it to the last minute. It is time consuming. Please make sure to do as much as possible before the deadline. Okay. So now another practice. Back to receivable. This is exercise 510. So this was 5, right? Not 6. 512. And now exercise 510. Chapter 5, exercise 10 of your textbook. It is on page 285. Recording bad debt expense and write-off using the percentage of credit sales. So the other method, the other way to do, so this is the allowance method. This is what we have done before, is the first practice. It was the means preparing an Asian balance of the receivable and do the allowance method. Now this is a practice on another approach where we calculate the bad debt as a percentage of the credit sales. As a percentage of the credit sales. So in this case, they say So during the current year, the company recorded credit sale of $5 million. Based on my experience, it is estimated a 2% bad debt rate on this credit sale. So if the estimate is given to you based on the credit sales, not based on the receivable, then this is the approach we are going to use, which is much easier. Much easier because the calculation will give you directly the bad debt expense. The bad debt expense is if I have 5 million of credit sales and 2% risk on non-collection, the bad debt expense will be simply equal to 5 million times 2%. And that's what would be in your journal entry. So you debit bad debt expense and you credit the allowance for doubtful account for $100,000. As easy, as simple as this. Means the number you get from when you multiply the credit sale by the percentage, that same amount is what will be in your journal entry, which is different from the other approach. The other approach, which is based on the receivable, when I get the number, the amount, that would be the ending balance of my allowance account. And then I have to make to find the X amount that will bring the balance from the opening to the end. Now the question is, how do I know which approach should I use if it was an exam? How do I know, should I proceed this way or this way? It is simply about carefully reading the information. If what the information is given to you, if the risk is assessed as a percentage of the credit sales, then this is what you do. Percentage of the credit sales, then the dollar amount of the risk is what you put in your journal entry. If the percentage is given to you as a percentage of the receivable, receivable is a balance sheet item. Credit sale is an income statement item. Two different approaches. Here, the credit sales is an income statement. The sale revenue, right? The 5 million, it comes from the income statement. Sales revenue. Then you apply the percentage of credit sales, and this is how you proceed. Bad debt expense is simply the percentage multiplied by the credit sale. But if the information given to you is the receivable and the percentage belongs to the receivable, and a receivable which is less than 30 days, the risk is 4%, 31 to 60, the risk is 5%. So these are percentage of the receivable, and the receivable is a balance sheet item. Then you have to do this approach, which is your calculation will give you the ending balance of the allowance for doubtful account, and then you find your X amount needed to bring the balance, the allowance from the opening balance to the ending balance. Okay. Now, for your information, this approach only private entity can do this. This simplified approach, this way to account for the debt, is not allowed for IFRS. The companies you are doing for your project cannot use this. Your percentage of credit sale approach is only accessible to private entity only. Public entity that use IFRS, they cannot do this. The only way to do it is the aged balance of the account receivable. Now, number 7. Problem 757 of your textbook. And this is on page 294 of your textbook. So it says on December 1st, 2023, this company reported the following information in its statement of financial position. Account receivable, $154,000. Allowance for doubtful account, $4,500 credit balance. Then the following transactions were completed during December 23. December 5, sold merchandise items for $67,000. An amount of $90,000 was received in cash, and the net on account terms 2, 10, and 60. And the total cost of the sales was $35,000. Journal entry. Go ahead. To record the sale. This is a post-midterm practice, which means you are already familiar with this. You did it for the midterm, for the practice. Go ahead. Just account for a simple sale transaction. Yeah. Debit, credit. Debit cash, but not all of the amount was cash. Yeah, I agree. Debit cash. We just collected $19,000 as cash, right? Okay. What if we start with the sale itself? So, sales revenue. How much? So, sold merchandise for $67,000. Okay, so $67,000 of sales. Debit cash and the balance. How about the balance? Yeah.
What's the other amount that was on the phone? Is it account receivable?
Account receivable, yeah, of course. On account, when they say sale on account, which means the balance is on account receivable. Okay? Now, account receivable. For the difference. Okay? This is to account for the sale itself, but the sale has a cost. We have sacrificed merchandise which is cost $35,000. The total cost of the sale was $35,000. So immediately after we record the sale, we also have to record immediately the cost of the sale, cost of sales. How do we do it? Cost of sale. So this is to account for the sale revenue, but the items that we have sold, they have a cost for us. The cost is $35,000. How to account for that $35,000 of cost of sale?
We credit our inventory.
Very good. And debit cost of goods. Exactly. Yeah, but we have given an up inventory, so it should be on the credit side. Merchandise inventory. And debit cost of goods sold, $35,000. And then on December 12, collected the amount due from the customer for the credit sale of December 5th. How much are we going to collect? How much? 48,000. Okay. The sale was done with this condition: 2, 10, and 60, which means you get a 2% discount if you pay within 10 days. The sale happened on December 5th. Payment was done on December 12th, which means we are inside the period. So our client deserves to get the discount, which means the cash amount we're going to collect is not the full amount, not the full $48,000, minus the 2% discount, because they paid before the period of 10 days. Okay, they have until December 15, they paid on December 12, which means they deserve the discount. Then, okay, let's do it step by step. The first step is that, okay, we are going to collect cash, okay? and the cash collected is not the full amount of $48,000. $48,000 times, right, 1 minus 2%, right? Do you agree with this? We are going to collect only $74,000. However, as we collect that amount, we clear the full receivable. The account receivable is cleared, right? For the full amount. There's no receivable anymore. Do you agree with this? If one may say, okay, since I collected $47,000, then I delete just $40,000 from the receivable. No, they have paid within the period of, so they have the right to make all of their receivable deleted, so they won't have to pay anything. So what is the balance then? How am I going to balance my journal entry? Debit, this is what collected, $47,000. Credit, this payment will clear the full amount of the receivable. What is that difference? The cash is here. So among the $48,000, we only get $47,000 of cash. Yeah.
960. Right, for the discount.
Which account?
Sales discount.
Sales discount. Exactly. Thank you. Sales discount, which is a debit, which is as a deduction of our sales for the difference, the 2%, which is $48,000 times 2%. Sales discount. Okay, that is my journal entry. So, debit cash for the cash amount collected, credit receivable for the total amount of the receivable. Because if I don't do that, which it will mean that there is something which is still pending. While there's nothing pending, they have paid fully what they need, and they deserve the discount of 2%. So the difference is sales discount. What is this? This is a counter revenue account. This is a negative revenue account. It will be subtracted from the sales revenue. When you prepare your income statement, you will have sales, $67,000, minus sales discount, so that you get the net sales. Good. Okay, and then on December 20, collected $90,000 in cash from customers for credit sales made on November 23. Simple one, this one. December 30, 20, we have collected $90,000 in cash from customers for credit sales of last month. Yeah.
Cash 90,000, debit, and account receivable. Credit.
Excellent. That's it. Debit, cash, credit, account receivable. Debit, cash, credit, account receivable. 90,000. Okay. And then on December 26, one of our customers that owed $3,000 to the company experienced financial problems and was forced to close its business in December. The full amount was considered uncollected. Okay, we have the amount. $3,000. Okay. Yeah. What do you think about this? One of our clients went bankruptcy, and we consider so far that the $3,000 is lost. There is no way to collect. Yeah.
For allowance for doubtful accounts.
Debit and credit.
Yeah, debit 3,000, receivable credit 3,000.
Good. Thank you. Exactly. So here again, I insist, because this is a very, very common reaction, which is wrong. Okay, is to say now that we have evidence that we lost $3,000, we are going to recognize the loss. No, No, you don't recognize the loss when it happens. You recognize the loss as soon as it becomes likely, just when it becomes likely based on an estimate as part of the adjusted entry at the end of the year, there where you recognize the loss. When the loss becomes a reality, it has already, you have a backup. From the beginning, I prepared the provision. Use that provision. That's it. You have to use the provision. You do not recognize a loss when the loss becomes a reality, but you just use a provision. What is the provision? The allowance for doubtful account. The allowance for doubtful account is a kind of provision, a protection, insurance. We keep aside so that in case a loss happens, instead of having that loss when it happens, we already have a provision. So you only hear, this is about the write-off. To count the write-off, you use the provision, which is allowance for doubtful account. Which is a contra asset account. This is not a loss account. This is a balance sheet account, contra asset account, and remove the receivable, clear the receivable, count receivable, $3,000. Okay, to write off the receivable. Good, excellent. That's it. Now this is the day-to-day transaction. Now we move to the adjustment entries. Determine the balance of the account receivable and allowance for doubtful account at December 31st. Okay. So let me do it here so that you can see. Excel is only a blackboard. What you can do on Excel or on the computer, you can do on your paper also. So it is required to calculate after these journal entries what is the ending balance. Okay, very simple. Prepare the T account. This is my paper. Okay, T account. Opening balance are given already. Account receivable. They say the opening balance, it is given on page 294, is $145,000. $154,000. Okay. All I have to know is on which side should I enter the number, debit or credit. Since this is account receivable, asset account, it increases on the debit side, increases on the credit side. And from the other side, they have the allowance for doubtful account. And this one is a contra asset account, a negative asset account, which means the balance is on the credit side. And they say it has a credit balance of $45,000. This was the situation before the journal entries. After that, what happens to these accounts based on the entries we have done already? So the entries we have done, they have, we debit account receivable $48,000. Debit account receivable $48,000. Just put it on the debit side, 48,000. Okay. And after that, I only need to keep track of these two accounts. The question is about these two accounts only, not everything. Whenever I find account receivable or allowance, and I update my numbers. So account receivable, debit, what else? And then after that, I have account receivable, credit, 48,000. Okay, credit, account receivable, 48,000. Okay. Now just to gain a few seconds and do it smartly, 48,000 on debit and 48,000 on credit simply means you can just remove them, right? So that you don't add the 48,000 while it will be removed. So that's what it is. And then receivable credit side, $90,000. $90,000 on the credit side, receivable. And then the last journal entry, debit allowance and credit receivable. Right? Debit allowance 3,000 and credit account receivable 3,000. That's it. It is the question is calculate the ending balance after all this transaction. So ending balance here, how much? 45 minus 300, 3,000, right? $1,500. And here, this disappears. $194,000 minus 90,000, right? That is 64,000 minus 3,000, 61,000. 61,000. Does it make a difference doing this on Excel or on paper? Absolutely no difference, right? So that is the answer to the question, okay? So, and then, where is my book? And then, so I answered. So determine the balance of the account receivable and the allowance. Okay, done. Balance of the account receivable 61,000. Balance for the allowance $1,500. And then they say. They say then the company uses the agent of account receivable method to determine the bad debt expense. They use the agent receivable. Okay, so this is not the credit sales approach. This is the allowance approach. The schedule below shows the estimate, and they say. I have the schedule here. Account receivable agent schedule. They have a total of $85,000 of receivable agent. There are 42,000 which are current, not yet due. 31,500 due over 1 to 30 days, and then $5,000 due 31 to 60 days. And over 60 days, $6,500. And this is the credit risk, the percent, where these percentage come from? They come from, where did they get this percentage, 1%, 2%? Previous experience, statistics, simply. Our previous experience. It shows that if you have a current debt, there is a 1% risk. If you have 1 to 32%. Next, we have to multiply the dollar amount by the percentage so that I get the dollar amount of the risk. So the first family of the first tranche, so 42,000 multiplied by 1%, and I keep doing this until I get the total amount of the risk, the dollar amount of the risk in total. $3,500. Okay, next, what should I do with this? Is this what I should put in my journal entry? The answer is no. You do this if it was the approach from the credit sales approach. What is the $3,500? I just calculated mathematically. This should be what in the books? The ending balance of your allowance. $3,500 is the total amount of the risk, the provision, the ending balance of your allowance. Okay. So the allowance now. The unadjusted balance is this. The unadjusted balance is the 45,000. So we started with 4,500. Okay, and then. On December 31st, there was 3,000 on the debit side. Where is it? 3,000 on the debit side. And now, yeah, go ahead. Opening balance, the transaction of 26, and the $3,500 should be here. the ending balance as per the agent. So this is what you should do. Place your mathematical calculation of the risk here, and then ask yourself, what should be my X to get to this ending balance? Opening balance 4,500 minus 3,000 plus an X amount, so that we end with 3,500. What should be that X? The difference, so $2,000 should be my X, the amount of the bad debt, and then after that I make the journal entry: debit, bad debt expense 2,000, credit, allowance for doubtful account 2,000. That's it. Yeah. Go.
Sorry, just to ask, where do we find the unadjusted AFDA team balance? The 4,500.
Given data. This is on the textbook. It's given on the textbook. It says on page 249. This is already given. They say open balance and adjusted $4,500. So, given data, so $4,500, we started the period with this, and then the transaction of 26 ended with a debit on this account, and then the X amount is your bad debt expense, so that you find the, because all of this is going to be presented this way on the balance sheet, on the SFP, on the statement of financial position, I'm going to have some assets. Among the assets, we have the current assets, right, as a subtitle. Among the current assets, we have cash, and we have receivable, account receivable. Account receivable, the gross amount, gross, minus the allowance for doubtful account, net realizable value of the allowance account receivable. The gross amount is what we have calculated, $61,000, minus the expected risk of non-collectability. This is what the aged balance gives. The aged balance, current 1 to 30, 31 to 60, over 60, that aged balance with percentage for every category, every rank, it gives the amount that will be in the balance sheet. The aged balance, the $3,500, gives the amount that will be on your balance sheet as a negative amount of the asset, as a contra asset account. So 61,000 minus $3,500. The net amount of the receivable is the difference, which means 58, right? 61, 57, 500. So this is what you have to keep in mind, that the calculation given by the aged balance is to calculate the provision, the allowance for doubtful account. Okay. Okay, so that's it for this practice today. Now, with regard to the big picture, the forest, where are we now, please? We have finished the accounting cycle. We spent many weeks on that, right? Where we learned how to prepare a financial statement, the cycle of the entries, until closing entries, right? Until we get to the financial statement. And then we made a break from financial accounting, where we did the ratio analysis. Okay, ratio analysis is not part of financial accounting, as we said. It is part of the financial analysis, which is the outcome of accounting, and the reason we placed it at that position is to allow you to start your project, right? Your analysis, your report, and then we get back to financial accounting to do what? A zoom in on specific item. We started with the cash and the receivable, and what we did, The practice is about cash and receivable, specifically for cash, bank reconciliation, specifically for receivable, how to account for the net debt expense. Next, we are going to do the inventory, another zoom in on a specific item of the assets. And then after that, another zoom in on the capital assets. And then after that, another zoom in on the liability. These topics are independent, completely independent, each from the other. They are not connected at all. Not connected means independent, which simply means now we get to a regular course, a regular class where I may miss an item, a topic, and then make up with another one since they are not connected. So if so for some reason you feel not comfortable with the receivable, you can skip it, no problem. In the final, we'll have just one problem about receivable. What you learned or what you did not manage to learn for receivable is not needed to understand inventory. Okay, so you may skip a topic and get familiar with another topic because they are not interconnected like before. Before, adjusted entries and financial statements are a single block. It goes together. Either I understand everything or I miss everything. But now we get to a kind more classical course where topics are independent and there is a way for you to invest, if you like, on specific topics without being harmed by missing information or missing understanding of the previous one. Okay. Okay. So next week we will do inventory. And that's it for today. Thank you for your participation.